Hey, I'm Dan Pascone, CEO of Tailored Wealth and host of the Making Sense of Your Money podcast, where every conversation is built around one idea: that your money is a tool to design and live your version of a rich life. If you've ever looked at your portfolio during a downturn and thought, I really don't want to be forced to sell into this, you're not alone. A lot of high earners build wealth almost entirely through the stock market and then realize that's also the only lever they have when it comes to time to actually live off of it. Today, I'm joined by Michael Parks, an 18-year corporate veteran turned real estate investor and fund manager at the Navigator Wealth Fund, where he runs a hard money lending business. We're getting into the real differences between owning rental property, investing in syndications, and lending, and why Michael walked away from bigger, splashy returns for something steadier, predictable cash flow that doesn't depend on the market cooperating. Before we get into it, make sure that you're subscribed on your favorite platform. And if the show's adding value for you, I'd really appreciate a quick review. It goes a long way. Thanks so much and enjoy the episode.
Brought to you by Tailored Wealth, helping business leaders live their version of a rich life.
Welcome to another edition of the Making Sense of Your Money podcast, where we cut through the financial noise and help business leaders to make smart, confident money decisions. All right, I'm excited about this conversation. Michael, thank you so much for joining the Making Sense of Your Money podcast.
Thanks, Dan. Glad to be here.
Yeah, this is going to be a fun one. And I really like not only your expertise, but your background, which we're going to get into it a bunch. I think our listeners are going to learn a lot from. So start off by telling us a little bit about your background, what's led you to where you're at today, and what you're doing right now.
So I think, maybe I would start with, I spent 18 years at Accenture doing IT consulting. I was a technology person right out of college. And after I left Accenture, I went to some publicly traded REITs, real estate investment trusts, where we ran 30 billion in assets. And I was the tech guy, but that's where I really learned the big business of real estate.
Yeah.
And started doing some on my own, and eventually changed that into a business that I now work in full time. So that's kind of the long story short.
So we're going to have to get into both aspects of that, both what you're doing today and sort of the transition, because I think both are kind of relevant for our audience. So first off, tell us a little bit about like that corporate transition from working from, a major consulting firm to getting into real estate, to then ultimately going off and doing your own thing. Tell us a little bit about like what prompted that, what motivated you to do that, and then like how you found that transition along the way.
Yeah, for sure. So I would say I was probably like a lot of typical successful executives. As they're moving along in their career, you continue to progress, get promotions, you make more money, you buy houses, and you have kids maybe, and we did, and have two boys, and then college and so forth. So your lifestyle kind of gets bigger as time goes on. But I've always been entrepreneurial at heart, and it was just very tough to think about, how do I make the leap out of a paycheck and into doing something on my own, and how do you bridge that gap? And it was mentally challenging to do it. But I've always enjoyed real estate. I had done a little bit of real estate investing on my own. But when I got to the REITs, I realized this is more of it can be a big business, right? There is a whole industry around real estate investing. And, I started educating myself, not only from our REITs, but because the REITs were a great model, but we're talking about billions of dollars. Right. So how do you start when you're one person, even a successful person, compared to billions of dollars of assets? And so I started small, right? I bought some apartments, and I bought some more apartments here in Massachusetts. So I live in Boston, Massachusetts, and just started doing that on my own, and then started realizing there's opportunities with real estate syndications and other funds that became more accessible. So after educating myself on how to do that, I scaled the REITs way down and started doing my own investing business with friends and family, where we purchased apartment buildings, larger apartment buildings than I would have been able to purchase on my own. And then that has since morphed into a lending business. And I have a partner that I work with full time. And so we created our own fund ultimately out of that.
Very cool. All right. So I do want to definitely get into that. Do me a favor, and just for a couple minutes, Michael, educate our audience on the various ways that sort of like high earning executives like you once were could think about investing in real estate. And I'll tell you from my perspective, I get a fair amount of new clients that come to us and say, I'm in a high earning position, but I don't have a ton of flexibility with respect to my work. And I eventually want to maybe leave the corporate world or sell my business, whatever their current outfit is. And I want to get to something that I'm still actively engaged in working in that can produce some levels of income. And oftentimes real estate comes up as an option. But I know that that can mean a lot of different things, and there's a lot of different ways to go about it. So do me a favor and just kind of educate our audience around with that profile in mind. How are the various ways that either you have done it yourself or you've seen others be successful in using real estate to fund a paycheck?
Yep. Yeah. So I mean, I'll use my examples, right? So when I first got started, in real estate, I bought a ski house up in New Hampshire.
Nice.
And like a lot of people, you say, hey, this sounds like a great idea. I'll buy a vacation property, I'll rent it out, it'll pay for itself, and I'll get to go use it and go skiing.
Sounds
Right.
amazing.
And sounds amazing. The reality is, if you're using it when everybody else wants to use it. And so either you got a rental property that's a business or you have a vacation home that you're enjoying. You really don't get the best of both worlds there. It's very hard to actually make that, that dream that seems easy of having your vacations paid for with your ski house. So with that said, I started there. I eventually stopped renting it. I made it a ski house. Our kids went skiing every weekend in programs. We had a great time. But then I got into, okay, so how do I invest for, a proper investment that would be a good return as opposed to trying to fund a lifestyle, which actually can be both, right? Because if you make a good return, you can use that money to fund your lifestyle and do whatever you want.
There you go.
And so that's when I bought 20 apartments in Massachusetts, and and I bought them over a relatively short period of time. When I bought them, I would say that they were, maybe break even, right? And then as the market continued to grow, I was able to start generating cash flow out of it. And I'd say that's another, I don't want to call it a myth. It's just hard to do, to be able to go out and buy a rental property and actually have it produce cash flow right away. That is a meaningful return. Now, real estate's a fantastic investment, particularly over the long haul in general, but you may have to put more cash in, that your return percentages could be lower initially, or it's just it's easy to say, well, I'll just buy it and rent it and make a bunch of money. When you do have those real estate investments that cash flow like that, kind of at the time you buy them, you usually need to do some significant work. It's in an area that maybe it's in a C-class area that there's a lot of tenant turnover. There's a lot of going to court and making sure tenants pay, and so there's a lot of work involved if you're going to make cash flow with those kinds of properties. Or you maybe the building itself is not in great shape, so you have to go in and run a renovation project and rehab it and make it better, and then after that you can get income that is worthwhile. So I would say kind of, the next area is just doing rental properties on your own, and at some point it's harder to scale that because there is work. Yes, it's considered passive income, but there is work. Even if you get a property manager, there is work to manage your property manager. And I did that. I had a property manager. So I think that's how a lot of people start. And then for me, I started learning about syndications, which is group investing. Much of your audience has probably heard of that. I know you know about it. And so my friends said, "Hey, I want to do what you're doing. Let's get together and let's purchase a larger building." And they have W-2 jobs, and they didn't really have the expertise. The expertise I learned from the REITs and from investing a lot of time on my own, and the experience I had. So I ran the projects. I found the deals. I put them together. I brought the funding. I signed the loans, and I ran the project. And for that, I was a general partner and received an outsized share of the returns. Now, my partners, who all felt like they were part of it because I communicate and tell them what's going on, but when decisions needed to be made and things were hard or there was work to do, they didn't have to do any of it. Right. And most of them didn't want to do any of it.
Of course.
Nor did they even know what to do, right? So I started doing real estate syndications, larger apartment buildings. 34 units in Tennessee. I did 143 units out in Kansas City. And I think the market changed a little bit. It just got very expensive for multifamily apartment properties. And so I started looking at lending as a better option. So lending to people that needed cash to do these types of projects and become the bank. So I became the bank and started lending, and that was really where I like the risk adjusted returns, and it creates steady cash flow because interest on a loan starts right away, interest pays right away, every month. And so, uh, and it's in a better position in the capital stack from a security perspective. The loan or the bank gets paid first before investors. So I would say, different ways you can own property, you
Yeah.
can lend against property, and then you can either you can own it all and manage it yourself. You can invest with somebody else who manages it, like in a syndication. So all of those options I've
All
done.
right. That's a great layout. So, with that as the backdrop, let's remove sort of owning and managing it yourself for a second, because at least I think most of the folks that I chat with don't necessarily want that responsibility. They've got busy lives, and the objective of this is the cash flow and potentially the tax breaks, but not added time, if you will. Can you compare for our audience what it's like from a return perspective, maybe from a tax perspective, and like an overall expectations of an investment to invest in a REIT versus a syndicate versus what you've started, which is the lending investment opportunity? Can you kind of compare those for us?
Yeah, for sure. So, for REITs, so a REIT is a group of properties that are then publicly traded with a ticker symbol and on the stock market. And I know you know this stuff, Dan. But I would say the advantages of investing with a REIT is you trade it just like you would a stock. So let's say if you want to invest in office buildings, there's an office building REIT. If you want to invest in multifamily, there's multifamily REITs. You want a smattering of different stuff, you can, there's REITs that cover multiple types of assets. You can buy it and sell it every day on the stock market like a stock. Very liquid, very simple. If you look at the returns on a REIT, and Dan, you've probably looked at it more than I do, just when I've seen them, they're not very good. I would say they're, 3, 4, 5, 6, 7% maybe on average. If you compare that to a syndication, so a syndication, it could be more than one asset. It's often one asset, but you're investing with a private group of people, and you're investing with a sponsor, somebody like me who runs the deal, and you invest with me on this particular project, and you know about the project because I'll tell you about it because
Mhm.
you want to know where your money's going, right? You want to know that that makes sense. Whereas a REIT, you really don't know exactly. You know the types of stuff it goes to, but you don't know the specific assets. With a syndication, you can see returns projected anywhere from usually 12 to over 20%, depending on what it is. The way I typically see the market is if you're buying an asset that is very light touch, like not a lot of construction work to be done, those sort of things, your projected returns might be 10 to 14, 15%. If you're looking at something that's a heavy value add, maybe it's higher, maybe 14 to 18%. If you're going to do a major renovation on a property, and if you're going to do ground up development or a major reconstruction of a vacant building, it should be, over 18 or up to, in the mid 20% probably. That's kind of what I see in the market. So a little bit of that is risk adjusted returns. Is
Right.
the higher, as you go up in risk, the more returns are expected. And all of them far outweigh the typical returns you see in a REIT. Now, there's no guarantees. Everyone knows that there's no guarantees in investing. So, but that's where projections come out in order to compel capital to come in. So when you look at it that way, I guess the last piece you asked about was lending. And so for us, we do hard money lending, which means we lend to people who have a hard time getting money from banks, for instance, that are low cost. So a bank might have an interest rate of 6.5% right now, something like that, but they have a lot of hoops you got to jump through to borrow. You have to have W-2 income to support it. You have to have credit scores. Can't be overextended. So people who are doing things like fix and flip on properties, they often have many of them. They look overextended. Because of that, their credit may be lower in score. So they are willing to pay much higher rates. So for us, we return investors 8 to 11% on the loans we make, but those loans are 70% of the value of the property. So there's a big cushion of security in those loans. And there's a lot of people who think 8 to 11% is way better than I could do in a REIT or in bonds or in dividend paying stocks. And they feel secure about the position it's in. So they like kind of that income, passive income that they can rely on, feel they can rely on. And so, yeah, it's not going to be the 18, 20% that you're going to get with a development project, but far less risk and more steady paychecks as opposed to those bigger returns usually come when the building gets sold in 5 years, that sort of thing.
Makes a lot of sense. And, what you're illustrating is pretty typical of any investment. The higher risk you take on, the higher the return expectation. Thinking about this in the broader context of a well diversified portfolio, right? And even potentially diversified income sources for that matter. Talk to us a little bit about, let's push REITs aside for a second, because I think those are generally simple to understand. Let's talk a little bit about two things: syndicates versus lending investments from a perspective of taxes, and then from a perspective of access, right? Like, what do you typically see the tax profile and the benefits being in each of those categories? And then how easy is it to get into one of these versus a REIT that anybody could just go buy on the publicly traded markets?
Yeah. So I would say when you're purchasing property, whether you're doing it through a syndication, you do it on your own, the tax advantages there's multiple, but some of the big ones are things called depreciation, which many of your audience I'm sure
Right.
know about. So it's paper losses on your asset where you don't actually lose money, but you get to deduct it. And so therefore you'll eventually repay it, but you will defer a lot of your taxes by taking depreciation. And with tools that are in the one big beautiful bill, and we're previously in with bonus depreciation and something called cost segregation. It's a way to basically turbocharge that depreciation. So you can get large losses on paper in your K1. So typically a syndication, you would get a K1. It's a partnership document, and on it you would see that you would have losses due to your depreciation. That means that as you get income, you know, you don't have to pay taxes. You can eat up your losses with your income until you eventually sell the property, in which case, a lot of times you end up having to repay it at that point, unless you do some kind of special tax treatment, like a 1031. So,
Right.
which is an exchange. And by the way, I'm not a CPA, and everybody knows that.
Noted.
So
Noted.
I've been around this stuff long enough that you learn a lot, but always consult your CPA.
Absolutely. Agreed.
So that's kind of the tax benefits. That now lending's different. If you lend, whether you lend yourself as a private money lender or you lend, invest in a fund like mine, when we lend, lending creates interest income, and interest income comes back in the partnership in the same K1, but it's in the interest box. So you don't get depreciation when you're lending. It's an income producing vehicle that is less about tax efficiency. You will get taxed on it, unless of course you find other deductions to offset it. So, and we can talk more about this if you want, because I know this is popular. I've listened to a lot of your stuff, Dan. And how do you fund a transition to a retirement or a semi-retirement or work optional life? How do you fund it? How do you think about managing your portfolio? And this is of course your expertise, but I could tell you a little bit about how I thought about it for mine, if that's interesting.
You're speaking my language. Let's go.
All right, and then you can tell me if I got it right or not. But so for me, I I ha- I looked at it and said, do I need to replace my salary? And that was my first question. And I have a wife that still works, and she has a great job too. So what we did is we looked at all of our expenses and we said, what are our must-have expense coverage? Like, we're not going to move, we're not going to leave our house, we're not going to not have a car, right? We're going to do things to support the base needs of our lifestyle, and what does that cost? And then we said, what are our wants? What are the things that we want to be able to do? We want to take so many vacations. We want to be able to buy our children a car when they graduate from college, and we want to do all the things we want to do. And then we said, okay, if we want to do that, what's that going to cost? And then we said, all right, how do we now fund that lifestyle and what do we need to do to fund it? And so when we start looking at, where her salary is and then what our investments need to produce, our investments didn't need to produce that much. It was actually a little surprising as I did that math in order to fund the lifestyle we wanted. Now, could I want a bigger lifestyle? Sure. Everybody probably can come up with a bigger lifestyle, but what do you want to do? Work until you die? I mean, at some point you say, this is a lifestyle I'm happy with. And so for us, what we did is we ended up doing a lot of this private money lending, hard money lending, because the returns were good. So I could put a certain amount of money into that. I felt confident in the interest income coming back every month. And that took care of all of that and my wife's salary. That took care of all of our needs and most of our wants. And then we still had a big chunk of our portfolio that we said we're going to put those in higher risk assets. So those are, in some cases, those are going into, multifamily real estate apartment buildings. In some cases, they're still in the stock market in various, portfolio assets. And we know when those go up and down, which they go up and down a lot, we don't worry about it because we don't need them for a while, right? And maybe we'll never need them. I don't know. Maybe our kids will get them. We'll see. So
I think that's spot on. Very much aligned with the strategy we talk about. We talk about this concept I call life driven investing, which is all about investing every dollar with what I call a job description. So it funds a portion of your life at a certain part in time. It might fund a goal. It might fund short term cash flow expense needs. It might fund long term needs. And to your point, it may never get utilized. What I like about what you're saying is the way that you sort of evaluated that. And frankly, that evaluation and then that analysis is one that I find most high earning business leaders don't make and they don't do until, frankly, probably too late. I just recorded a new video. It's not even live yet. And it talks about some form of early retirement. I call it hybrid retirement and the ability to do that earlier in your life when you have high energy, high flexibility, and you're really driven and motivated to want to take experiences, both personally and professionally, frankly, right? Like getting into professional projects that are engaging and important to you and purposeful, and then doing the other lifestyle stuff, whatever that is for you, whether it's traveling with a partner or whether it's spending time with kids or grandkids, et cetera. But the ability to enjoy that time when you have, the most energy and you're most committed to doing it is a really, really important thing to consider in the context of your broader life. And then you sort of back into what do you need your financial plan to do to support that? And most of the time, people are surprised by what really is possible when they actually run the math. And, we have software that we use to model all this out. But what I love that you're saying is oftentimes just a little bit, it doesn't, a lot of people think, well, I got to replace my salary because I've got this lifestyle that I've come accustomed to. And nobody wants to give up the lifestyle they're in. I've never once, wanted to or tried to push someone to reduce their lifestyle, right? The idea is you've come accustomed to a lifestyle. How do you now be able to live that lifestyle with a higher degree of flexibility, with maybe a higher degree of purpose with your work? Well, a lot of times, just some form of passive income, whether that be consulting work, fractional work, real estate investing, investing in some other business, a franchise, whatever. I could go on and on. There's 10 different things that I've seen people do, probably more, that produce some levels of income, may not necessarily replace your W-2 income right away, but it produces some level of income, which reduces the stress on your portfolio. And by the way, regardless of how it's structured, it's more tax efficient than your W-2, right? We can get into all the tax mechanics of it. We're not going to do that for today's conversation. But the minute you walk out the door of the corporate world, the tax code opens up for you. I always say, W-2 high earners are the IRS's best friend, right?
yeah, for sure. Yeah, I mean, and that was part of a little bit of the surprise for me going through that exercise around when you start saying, okay, maybe I'm not going to be paying taxes at that tax bracket I was. I'm going to pay them at a much lower tax bracket. That's helpful. Do I really need to be contributing to 401ks and IRAs and retirement things given where I am in life, or do I want to keep more of that money in my brokerage account to fund my lifestyle between now and whenever I decide retirement is? right? And so that becomes a big chunk. And then I've got children. One just graduated from college, so he's
Congrats.
off the parents' dole. Yeah, so
Well,
that's
congrats on
good.
multiple levels. Congrats on multiple
Yeah,
levels there.
we still help him out, but he's got a job, so kids are expensive,
Yeah,
and
sure.
so when your children finally get off of your wallet to some degree, that's helpful. And the amount of money you spend when you're in a W-2, I mean, for me, I never had the luck of working close by. There's commuting costs and miles you put on cars and gas and going out to eat lunch and like dinners, and just you put it all together and it's like, okay, now that I work from home and I work for my clients, but I have a lot of flexibility, it's just surprising how little miles are on my car.
Right.
Just, I find myself going for rides just to get out of the house and have some fun, as opposed to, commuting an hour and a half each day, but, round trips. So it's great lifestyle for me with this. My purpose now is to continue to build this fund and make my investors feel the freedom I have. That's where my purpose is. I can't just, like, I'm too young to stop doing anything, right?
Right.
But so I love that. I love interacting with people and helping people on their journey. That's exciting. It's motivating for me. And yet I love the flexibility of, maybe today I can, go do something fun with my son who's home from California, or whatever. The flexibility is what's great. Look, big location flexibility, time flexibility to choose when to do what you want to do, what you need to do for your job.
Very, very cool. And I love that you're able to, achieve that lifestyle and now kind of pay it forward and help others to potentially get there. So, on a more technical note, Michael, if folks are interested in a fund like yours, what should they be thinking about in terms of minimum investment, in terms of holding period, in terms of payout timeframes? Give us a little bit more of the mechanics of how they should be thinking about it in the broader context of their financial plan.
Sure. So right now, like I said, we're focused on our fund is lending, right? So the terms we have is it's a 50,000 minimum, and that caps in a return rate of 8%. 250,000 minimum is a 10% return cap, and a million minimum is 11%. So that's the way we've structured our fund. So your return percentages can go up based on how much you've invested with us, and all of our loans are 12 months. So based on when you get in the fund, it's usually a 12 to 18 month hold period to get your capital back, and you get your interest along the way. We pay interest quarterly. So interest, you can choose to get those as checks or just roll them forward to reinvest. That's up to you. But if you want, I've got people that do both. Some are like, I don't really need this money right now. Just keep reinvesting it. Great, we'll do that. And others say, I want that check showing up because that's how I make sure I'm paying whatever they're paying for, paying their bills or doing whatever they're doing. So yeah, so for us, the lockup period's 12 to 18 months. And then you can choose to roll that forward if you want.
Yeah, I think I'm glad that you shared that because my takeaway from that is, especially with the folks that I speak with, something like this, like hard money lending, seems on its surface super complicated, but that structure that you just laid out is very, very simple. I mean, it's super easy to understand. You got three different tranches that defines your return. You have a short lockup period, and you're getting checks almost out of the gate. So that makes a lot of sense. All right, very, very cool. Well, thanks for sharing that. All right, let's transition a little bit, Michael. I want to put you through a quick version of our lightning round here. All right, so the audience can learn a little bit more about you. So the idea with this is just first thought that comes to your mind. Could be a quick answer, could be a long drawn out thought. You ready?
You bet.
All right, let's do it.
Let's go.
One meal for the rest of your life. What is it?
Ooh, I'm from New England. Got to be lobster rolls.
All right, lobster rolls. That sounds good right about now. It's getting hot out. That sounds good right about now. One technology tool, whether it be software or hardware, other than your computer or phone, that you can't live without.
Well, it's going to sound cliche, but I can't live without my Chat GPT anymore. I mean, it's amazing what that's doing for reducing my legal bills and other things. It's like having a I know there's one of them called Copilot, but it's like having a Copilot with you.
There you go. No, the AI is certainly taking the world by storm. That's for sure. What's one experience in your life that shaped how you think about money today?
Well, I mean, yeah, you asked for one. When I first graduated from college and got out to the workforce, I started doing some investing, and I didn't know much about it, to be honest. My parents never did. And so I started buying, I was a stock picker. So I mean, I just started picking stocks I liked. And I remember picking Lucent, which was right around the dot-com bubble
Sure.
area, right before that. Lucent went out of business. So that stock went to zero, literally zero. So that was a tax write-off. That was good.
Nice.
The good news was I was too young in my career to have enough money that it was meaningful to me at the time, but it was not ultimately meaningful in my life. And then the dot-com bubble burst certainly after that. And I would say that that has continued to stick with me is the ups and downs of the stock market. We got it again in 2009, 2008. And because of that, I don't fully trust everything in the stock market when it comes to wanting to live off my portfolio, which is why I feel I need these alternative passive income sources. So I know it's a lightning round. I'll stop.
No,
Sorry.
that's
We'll
good.
keep
That's
moving.
good. No, that's good. What's one habit or like process that you subscribe to that's had a major impact on your success?
I'm a list maker.
Okay.
So I probably have reinvented the way I keep my to-do lists probably every 2 or 3 years. The one I'm working on now involves sticky notes and piece of paper. And I got sticky notes for each subject area of things I'm tracking. I got things for the fund. I got things for each project. I got things for each loan. And uh, and so that's how I stay organized.
Nice.
I keep the list making is what keeps me on track.
Very cool. What's the best money under $1,000 you've ever spent?
Probably my cordless drill.
All right. That's a good one. All right.
It might. I mean, I know everybody's got one now, but that might be the best tool going back. You can do anything with that.
I love it. I love it. All right. Last one. What's one piece of advice you'd give your younger self?
Start earlier. Start earlier with real estate. The best time to get in real estate was always 5 years ago. And when I went to buy my first house, I found there was a 4-family that had a garage that was being rented out commercially, and I was like, this cash flows. It's the first house I found that cash flows, and I wanted to buy it. And at that time, I had just got engaged to my wife, and she said, "You travel for work. I am not having tenants come to the door and tell me they got problems." Like she's like, "This isn't gonna work." And so I threw that idea out the window.
Okay.
Bought a single family house. We moved in, had kids, bought the ski house, and didn't start my career in real estate for another 18 years.
Happy wife, happy life. I don't think you can regret that one.
No, that part did work out.
Nice, nice. All right. And then lastly, if our listeners want to connect with you, collaborate, learn more about your fund, what's the best place to find you, Michael?
Yeah, we've got a website, navwf.com. That's Navigator Wealth Fund is the name of the fund, navwf.com. And on there, you can book a meeting with me. My email is michael@navwf.com as well.
Very cool. Well, thanks for sharing. Appreciate your time and insights today. This was great.
Thanks, Dan. That was
bet.
a lot of fun.
Yeah, I enjoyed it. That's it for the episode. You can find our podcast along with our newsletter and YouTube channel all for free at makingsenseofyourmoney.com. And as always, make sure to prioritize your version of a rich life.